All right, so let's imagine a scenario. Okay. You're a bank examiner, and you're going through a bank's records, and you think, I think this might be a violation of Appendix A to Part 364.
Mm.
It's kind of a mouthful,
Yeah.
but it's also a pretty big deal.
Yeah, definitely a mouthful. And you hit the nail on the head with the big deal part. Appendix A to Part 364, that's the interagency guidelines establishing standards for safety and soundness. Basically, it's the rule book for making sure banks are, well, operating safely and soundly.
It's kind of like the ultimate checklist for bank examiners, making sure banks aren't cutting corners or playing fast and loose with, well, anything, really.
Exactly. And the stakes are, they're really high here. Because if a bank isn't following these guidelines, it can have some pretty serious consequences. We're talking potential risks to the deposit insurance fund, which is the fund that protects depositors, like you and me and everyone who has money in a bank.
So no pressure, right?
Right. But that's exactly why we're doing this deep dive. We want to give examiners, like yourself, the knowledge they need to really assess a bank's operations and make sure they're playing by the rules.
So let's break it down. What exactly does Appendix A to Part 364 cover? What are the key areas that examiners are looking at?
It's a pretty broad scope, really, but it all stems from Section 39 of the Federal Deposit Insurance Act. And that section mandates that all the federal banking agencies, the FDIC, the Fed, the OCC, they all have to work together to establish these safety and soundness standards.
So it's a collaborative effort.
Yeah, absolutely. The idea is to catch problems before they become major issues.
Right.
That way we're protecting both the bank itself and the deposit insurance fund. It's all about being proactive.
It's like a preemptive strike against financial chaos, basically.
What? Exactly. So you're looking at things like a bank's internal controls, their loan documentation practices, their asset quality, even their compensation practices. There's a lot packed into Appendix A.
Wait, there are rules about how much a bank can pay its employees. That's interesting.
Yeah, definitely. And it's not just about the dollar amount either. It's about how those compensation packages are structured. Because believe it or not, the way those incentives are set up can actually encourage risky behavior. And that obviously can lead to some pretty big problems down the line.
That's fascinating. So you're saying a highly compensated employee might actually be more likely to take risks. It seems counterintuitive.
It's all about how those incentives are structured. We'll dive into the specifics a bit later. But first, let's break down the three main types of standards required by Section 39. Kind of like the three pillars of Appendix A, you could say.
Okay, I'm listening. What are those three pillars?
First, you've got your operational and managerial standards. These are really the nuts and bolts of how a bank runs on a day-to-day basis. Then you've got standards related to compensation, which we just touched on. And lastly, there are standards related to asset quality, earnings, and stock valuation. Basically, making sure the bank is financially healthy and stable.
So it's a holistic assessment, looking at the bank from all angles to ensure its stability.
Exactly. It's about looking at the big picture. Now, let's say a bank isn't meeting one or more of these standards. What happens then?
Yeah, what are the consequences? Do they just get a slap on the wrist?
Not quite. They might be required to submit a compliance plan to the appropriate agency, outlining how they're going to fix the issue and meet the standards. And there are deadlines involved. The agencies are pretty serious about making sure these things are addressed promptly.
So it's not just a suggestion, it's an expectation.
Right, exactly. There's a process in place to make sure they're held accountable.
But Appendix A doesn't limit the agencies, right? They can still take other actions if needed, depending on the situation.
Absolutely. Section 39 and Appendix A don't tie their hands. They've got a whole toolbox they can use to address unsafe or unsound practices, and they won't hesitate to use them if necessary.
So as an examiner, it's important to not only be familiar with Appendix A, but also with the broader regulatory landscape.
Definitely. Now, to really understand these standards, we need to start with some key definitions. Some of the language can be, well, a bit technical.
Okay, let's get into that. What terms are we talking about?
Well, executive officer, for one. It sounds straightforward, but in the context of Appendix A, it's not just about someone with a fancy title. It refers to anyone who has significant responsibility for managing the bank's affairs, regardless of their official position.
So it's more about their level of influence and decision-making power, rather than just their job title.
Exactly. Another crucial term is compensation. And that doesn't just mean base salary. We're talking about all the direct and indirect payments, benefits, everything someone receives. Stock options, bonuses, perks, the whole package.
Okay, I get it. So we've got our definitions straight. Now let's tackle those operational and managerial standards. There are 9 in total, right? Where do we even begin?
Let's start with internal controls and information systems. These are kind of like the nervous system of a bank.
Okay, I'm intrigued. How so?
Well, they're responsible for ensuring that information flows correctly, securely throughout the entire bank. If there are weaknesses in these systems, the whole bank becomes vulnerable.
It's like a chink in the armor.
Exactly. And that's why examiners scrutinize this area so closely. Now, another critical standard is the internal audit system. I think of this as the bank's immune system.
I like that analogy. Tell me more.
The internal audit function is constantly checking for problems, making sure things are working as they should be. It's about identifying and addressing issues before they blow up into something bigger.
So it's an ongoing process of monitoring and
Hmm.
course correction, constantly checking for any signs of trouble.
Exactly. Now let's move on to something that might sound a bit mundane, but it's actually incredibly important. Loan documentation.
Paperwork.
Hmm.
Not usually the most thrilling topic, but I have a feeling you're going to tell me why it's so crucial in the banking world.
You bet. Clear and complete loan documentation is absolutely essential for a bank to make informed lending decisions, assess risks, and protect themselves legally. If the documentation is sloppy or incomplete, things can go south very, very quickly.
Give me an example. What could go wrong if a bank's loan documentation isn't up to par?
Imagine a bank approves a large loan, but the documentation is missing key information or it's just unclear. Down the road, if that borrower defaults, the bank might have a really tough time collecting on that loan or even proving that the loan was properly authorized in the first place.
So it's not just about dotting the I's and crossing the T's. It's about protecting the bank's interest and ensuring that everything is done by the book.
Exactly. And that brings us to another important standard: credit underwriting.
This one sounds a bit more familiar. Isn't this all about making sure the bank isn't lending money to people who can't afford to pay it back?
That's the gist of it, yeah. It's about assessing a borrower's ability to repay a loan. But it's more than just checking their credit score. Banks have to look at the borrower's overall financial situation, their employment history, their resources, their willingness to repay. It's a more holistic assessment.
So it's about looking at the whole picture, not just the single data point.
Precisely. Now let's shift gears a bit and talk about something that can make or break a bank: interest rate exposure.
Okay, this one sounds a little more complex. Break it down for me.
Well, you see, interest rates are always fluctuating, and those changes, they can have a huge impact on a bank's profitability.
Yeah, I can see how that could be a problem, especially if rates rise quickly.
Exactly. If a bank isn't managing its interest rate risk effectively, it could end up losing a lot of money very quickly. In fact, you remember the savings and loan crisis back in the 80s.
Vaguely. Refresh my memory.
Well, that crisis was partly caused by banks not properly managing their interest rate exposure. They were caught off guard when rates went up, and it led to widespread financial instability. So this is definitely an area that examiners take very, very seriously.
I'm starting to understand why bank examiners have such a tough job. It's like they're financial detectives, looking for clues that might indicate trouble down the line.
That's a great way to put it. Now let's move on to a standard that might seem counterintuitive: asset growth. You might think rapid growth is always a good thing for a bank, but it can actually be a red flag for examiners.
Wait, really? Why would that be a concern?
Think of it like a plant that's growing too fast. It might become tall and impressive, but its roots might be weak, and it could topple over easily. The same principle applies to banks.
So uncontrolled growth could actually make a bank more vulnerable, not stronger.
Exactly. Examiners are looking for sustainable growth, not growth at any cost. They want to see evidence that the bank has the infrastructure, the expertise, and the risk management capabilities to handle that growth responsibly.
It's like making sure they're not biting off more than they can chew. All right, what's next on our list of standards?
Let's talk about asset quality. This one's all about identifying and managing problem assets, things like bad loans, for example.
Yeah, okay, I'm following you. So how do banks go about managing those problem assets?
Well, first, they need to have systems in place to identify those problems early on and take steps to minimize losses. And they also need to set aside enough reserves to cover potential losses. Remember, the goal is to protect the deposit insurance fund from being impacted by those bad assets.
It's like a rainy day fund for the banking system, making sure there's a cushion to absorb those potential losses.
Exactly. It's all about being proactive. Now, the next standard is pretty straightforward: earnings. Banks need to be profitable to survive. And examiners want to see sustainable earnings, not just one-time gains or flukes.
So if a bank's profits are too reliant on a single source of income or a one-off event, that could be a red flag.
Absolutely. Examiners are looking for diversification and stability in a bank's earnings. They want to see multiple streams of income that are reliable over time. It's about making sure the bank has a solid foundation for the long term.
Okay, that makes sense. So we've covered 8 of the 9 operational and managerial standards. What's the last one on the list?
We've come full circle back to compensation, fees, and benefits. This ties back to what we were talking about earlier, how compensation isn't just about salary, it's about the whole package.
Right, and you said that the structure of those compensation packages can actually encourage risky behavior. How so?
Well, let's say a bank has a compensation structure that heavily rewards loan officers for closing a high volume of loans, but it doesn't take into account the quality of those loans.
I can see where this is going. They might be tempted to approve loans to just about anyone, regardless of their creditworthiness, just to hit those bonus targets.
You got it. And that could lead to a spike in defaults, which would ultimately harm the bank's financial health.
It's a ticking time bomb. The short-term gains could lead to long-term pain for the bank. So examiners are really looking for those cause and effect relationships between compensation structures and the bank's overall risk profile.
Precisely. They're trying to connect the dots and make sure that the bank's compensation practices are actually promoting sound decision-making, not encouraging excessive risk-taking.
All right, so we've covered the 9 operational and managerial standards. What's next on our Appendix A journey? What other areas would you be looking at as an examiner?
Well, there's another really important section we need to unpack. The prohibition on compensation that constitutes an unsafe and unsound practice. This is where things get really interesting.
Ooh, that sounds intense. Let's save that for part 2 of our deep dives. All right, so before we jump into, the specifics of what makes a compensation practice unsafe and unsound, let's just zoom out for a second. Why is this even such a big deal for examiners?
Well, it really boils down to incentives, right? Like we were saying earlier, how a compensation package is structured can really influence people's behavior. And if those incentives, if they're not aligned with the bank's long-term health, it can basically create a breeding ground for, risky decision making.
It's like you're setting up a system where people are actually rewarded for doing things that could end up harming the bank. That just seems, I don't know, backwards.
Yeah, exactly. And that's why Section 39 of the FDI Act, it specifically calls out excessive compensation as an unsafe and unsound practice, because it recognizes that if you have poorly designed compensation programs, it can actually threaten the safety and soundness of, well, the entire banking system.
So how do we even define excessive in this context? Is there like a magic number or a formula that examiners use?
I wish it were that simple. But no, it's a bit more nuanced than that. Appendix A, it lays out a bunch of factors that examiners consider when they're trying to figure out if compensation is excessive. It's not just about the dollar amount.
Okay, so what are some of those factors? Like, what would make an examiner raise an eyebrow and take a closer look?
Well, for starters, they look at the total value of all the benefits. And we're talking about everything here. Cash, non-cash, base salary, bonuses, stock options, company cars, retirement plans, the whole shebang.
So it's about the big picture, not just what's on the surface.
Right. They also look at the person's compensation history, like how their pay has changed over time and whether those changes are, justified by their performance and also by the bank's overall financial performance.
So it's not just about looking at one year in isolation. It's about looking for patterns over time and making sure things make sense.
Exactly. And they don't just look internally either. They compare that individual's compensation to what other people with similar expertise are making, both within the bank and at comparable institutions. It's all about benchmarking.
So they're making sure things are in line with industry standards and that they're not creating like a weird incentive structure where people are being rewarded for taking too much risk.
Exactly. It's about fairness and responsible practices. But it goes beyond just comparing numbers.
What else are they looking at?
Well, they consider the bank's financial condition, the complexity of its operations, the risk profile of its loan portfolio. Even the geographic location can play a role.
Wow, so it's a really comprehensive analysis, taking everything into account.
Yeah, they're trying to get the full context right. Remember, the goal is to identify any compensation practices that could potentially harm the bank's safety and soundness. And that brings us to another big one. Any link between the person's compensation and, fraudulent activity or a breach of fiduciary duty.
So if there's even a whiff that someone's getting paid for doing something shady or unethical, that's a huge red flag.
Oh, yeah, absolutely. That's a big no-no because it suggests that the compensation structure is incentivizing the wrong things. And then, things like post-employment benefits, those golden parachutes we hear about, examiners are going to really scrutinize the cost and the benefit to the institution.
They're not just looking at the immediate costs, they're thinking about the long-term impact as well.
Exactly. Making sure those post-employment benefits are reasonable. Okay, so we've talked a lot about what makes compensation excessive. But what about compensation structures that on the surface might seem okay, but could still end up causing, big financial losses for the bank?
Yeah, what about those?
Well, that's another crucial area that examiners focus on, because even if the dollar amount isn't necessarily over the top, the way the compensation is structured can create some pretty perverse incentives.
Can you give me an example of what you mean?
Sure, let's say a bank has a compensation structure where loan officers get big bonuses for closing lots and lots of loans, but it doesn't really take into account the quality of those loans or the risk that those loans might go bad.
I'm seeing where this is going. So they're basically being encouraged to just churn out as many loans as possible without thinking about the long-term consequences.
Exactly, and that can lead to a ton of defaults down the road, which obviously hurts the bank's bottom line and potentially even puts the deposit insurance fund at risk. So that's a classic example of how compensation can lead to problems, even if it's not technically excessive on its own.
So examiners, they're really looking for those cause and effect relationships, trying to understand how compensation decisions might influence behavior and ultimately impact the bank's risk profile.
Yep, exactly. It's all connected. And it's about making sure those compensation practices are actually promoting, smart decision making, not encouraging people to take unnecessary risks.
This has been really insightful. It's clear that reviewing compensation practices, it's not just about checking off boxes on a form. It requires a pretty deep understanding of how the bank operates, what its risk tolerance is, and how those compensation decisions might influence behavior.
Yeah, it's like being a detective and a bit of a psychologist, too. You got to understand the motivations behind those decisions.
So, for our listener out there, who's probably an examiner reviewing a bank, what's the key takeaway here when it comes to compensation? What's the big thing to keep in mind?
Don't just focus on the numbers. Dig a little deeper. You want to understand the incentives that are built into those compensation structures. Figure out if they're aligned with safe and sound banking practices. And think about the potential impact those decisions could have on the bank down the road.
It's about seeing the big picture, making sure those compensation practices are actually helping to create a stable and healthy bank, not creating unnecessary risks.
Exactly. Now, we've covered a lot of ground here, from the big picture requirements of Section 39 all the way down to the specifics of compensation analysis. It's a lot to take in.
Yeah, definitely. But it's important stuff. And it highlights how Appendix A, it's not just some, boring technical document. It's a roadmap for protecting our banking system and making sure depositors' money is safe.
Well said. Now, before we wrap up, I have a thought for our listeners to, chew on. We've been focusing on the regulatory side of things, but what about the banks themselves? What kind of challenges do they face when they're trying to balance these regulatory requirements with, running a business and trying to make a profit?
That's a great point. It's got to be a constant balancing act.
It is. They want to be profitable. They want to be competitive. But they also have to operate within this, pretty complex web of regulations. It's a tightrope walk for sure.
And finding that balance is important, not just for the individual banks, but for the whole economy.
Exactly. And for you as an examiner, understanding those challenges, it can help you do a better job.
It's about having empathy, I guess. Recognizing that the banks aren't the enemy, and that we're all working towards the same goal, a safe and sound financial system.
Well put. It's a partnership, really.
All right, well, I think that's a good place to, pause our deep dive into Appendix A to Part 364 for now.
It's been a pleasure.
So we've talked a lot about how important it is to make sure that compensation practices are aligned with, safe and sound banking. But it can be tough to spot those red flags sometimes. So for our listener out there, the examiner who's actually in the trenches, what are some concrete things to look for when they're reviewing a bank's compensation structure? What are some of the warning signs?
That's a really good question. It's like you're putting together a puzzle, right? Looking for those little clues that something might not be right. I think one of the biggest red flags is when you see incentives that are super focused on short-term gains, without much consideration for the long-term risks.
Can you give me an example? What would that look like in a real-world scenario?
Yeah, totally. Imagine you've got a bank and their compensation structure for loan officers is like all about originating a high volume of loans. And their bonuses are tied to hitting these like really aggressive lending targets, but there's not a lot of emphasis on, the quality of those loans or whether the borrower can actually repay them.
So they're being incentivized to just churn out loans, basically, without really thinking about whether those loans are, actually good loans.
Right, exactly. It's that short-term thinking that can really come back to bite you. The loan officers might be hitting their targets and getting those bonuses, but the bank could end up with a whole portfolio of bad loans. And that's going to hurt them in the long run.
Yeah, it's like building a house on a foundation of sand. It might look good for a while, but eventually it's going to crumble.
So, as an examiner, how would you approach a situation like that? What would you do?
Well, you'd want to really dig in and try to understand why they've set up their compensation structure that way. Are there any mitigating factors in place? Are they doing anything to make sure that loan quality is being considered? Are there checks and balances to prevent people from taking too much risk?
So it's about asking tough questions, making sure they've really thought this through, and that they have a plan to manage those risks. Yep, exactly. Another thing to watch out for is excessive complexity in the compensation structure. If it's really hard to understand how they're calculating someone's pay or what factors are driving those decisions, that's a red flag for me.
It's like they're trying to hide something.
Right. Transparency is super important. Examiners need to be able to see how the compensation is being determined and if it's, in line with safe and sound banking practices. If it's all shrouded in mystery, that's a problem.
It's about accountability, basically, making sure those compensation decisions can stand up to scrutiny. Now, what about situations where a bank is, really struggling financially, but the executives are still getting these big, fancy compensation packages?
Ooh, yeah, that's a big one. That's a sign that maybe the bank's priorities are a little out of whack. Like they're more focused on taking care of themselves than on fixing the problems.
Yeah, it's like they're fiddling while Rome burns. Not a good look.
Exactly. In that situation, you'd really want to look closely at whether those compensation practices are making the bank's problems worse, or at least preventing them from getting better.
So it's about figuring out if those compensation decisions are part of the problem or part of the solution.
Right. And it's not just about the money either. When a bank is struggling and the executives are still getting these huge payouts, it can really hurt morale among the employees. And it can damage the bank's reputation with the public.
Yeah, it creates this sense of unfairness. Like, we're all in this together, but some people are being treated better than others.
Exactly. So, when you're looking at compensation practices, you got to think about all of that. The bank's financial health, the risks they're facing, and how those decisions might impact the employees, the public, the whole system. It's about the big picture.
It's about connecting the dots, seeing how all those pieces fit together.
Well, this has been a really fascinating conversation. I feel like I've learned a ton about Appendix A to Part 364 and how it all ties into this idea of responsible compensation practices in the banking industry.
Yeah, it's been great chatting with you. Hopefully our listeners out there who are, doing this work every day, they feel a little more prepared to tackle these challenges now.
I'm sure they do. And, it's a reminder that Appendix A, it's not just some dry technical document. It's really about protecting our financial system, making sure that banks are operating safely and responsibly, and that everyone's money is protected.
Couldn't said it better myself.
Well, that wraps up our deep dive into Appendix A to Part 364. Thanks for joining us today.
My pleasure. It's always great to talk about this stuff.